These are in listen-only mode.
Good afternoon. My name is Tim Tormone, Associate Executive Director of Engagement and Outreach for the University of Maryland Alumni Association. I'm pleased that you're here today to listen to Who the Heck is FICO, presented to you by one of our fantastic affinity partners, CQ. Our presenter today is James Toby Smith, Assistant Vice President, Lending for CQ Maryland. Toby has direct oversight and management responsibility for the following lending areas within the organization: mortgage, home equity, consumer, loan quality, lending initiatives, secondary marketing, and business analysis. Toby has been with CQ since November 2010, and prior to that served over 13 years in various production-based roles with a Big Four national bank. Toby holds a BS degree in management from Frostburg State University in Maryland. In addition to his position with CQ, Toby is an executive member of the American Financial Services Association, sits on the executive committee with the Greater Baltimore Board of Realtors, is a member of the Prince George's County, Maryland chapter of the NAACP, and has served as a mentor with Big Brothers Big Sisters in Maryland. He is married with one daughter. Please, if you have any questions during the presentation, please type them in the question box, and we will get to as many of those questions as we can at the end of the webinar. With that introduction, I will turn over the webinar floor to Toby.
Thank you, Tim. I appreciate the opportunity to speak to everyone today. So who the heck is FICO? That's the topic of our webinar, and really FICO means a lot of different things to a lot of different people, but at its core, FICO was founded as a corporation. It was originally known as Fair, Isaac and Company, founded by Bill Fair and Earl Isaac. They were, well, it is today, it's a data analytics company. It's based out in California, but everybody really, for all intents and purposes, knows FICO as the credit score people. What's my credit rating, what's my score, and what does that mean? So they're focused on primarily credit rating services, and just as a little nugget of information, FICO it's a measure of a consumer's risk, and we'll get into that today, consumer credit risk. So no business lending is normally taken into account with FICO scores. They have their other scoring methods, but it really has become a true fixture within the United States for with regards to the credit scoring market space. As a little fact here for everyone, in 2013, as of 2013, lenders purchased more than 10 billion FICO scores from different vendors that offer it. And in addition to that, it was approximately 30 million more Americans access their own credit scores. So we'll talk a little deeper as the presentation goes on today, but the education and awareness level among American citizens is really taken off in the last 5 to 10 years with regards to their credit score. Some of that's been driven around identity theft, but more importantly, it's just overall awareness and understanding the importance of that credit scores play in your typical everyday life. So with that having been said, we'll move on to the next screen here. So we're talking about credit. Credit is, simply put, the ability to have or buy something now and pay for it later. However, what many folks don't understand is that credit comes in a number of forms. You typically hear about credit cards and you hear about your auto loans. Those would be called installment loans. However, a lot of folks really don't pay attention to the fact that there are many other types of credit that are out there. Your retail accounts, so your department stores, your Kohl's, your Macy's, your Targets, your Old Navy, your Gap, all those stores offer oftentimes private labels of credit with other finance companies that are out there, but it's all credit nonetheless. They're finance company accounts, and your finance company accounts could be your automobile loans that aren't financed with your typical captives, your American Honda Finance, your Ford, your GM. So they're out there, and then of course you have your mortgage loans, inclusive of home equity as well as typically buying your first home or refinancing a home. But generally, credit boils down into 3 different types. You have revolving, installment, and open. Now, a lot of folks have questions around what the open credit means, and by open, those are typically your charge cards that don't allow you to carry a balance on the card itself. American Express is a prime example of an open credit card. Whatever you charge in a current month needs to be paid off the next month. There is no credit. You don't get to carry that. So that's more of a charge card more so than a credit card. Credit card allows you to simply carry it and make payments towards your balances. But other lesser known types of open credit would be something that probably everyone listening to me now has. It's either your cell phones, it's your gas and electric bills, it's that are associated with your place of living. It could be your credit, your cable bill, your direct TV or FiOS, whatever you use. Those are all examples of credit. You're getting the service up front now for a promise to repay that bill the next month. So just some facts around credit. It's more than just your typical credit cards and your auto loans and your mortgage loans. It's the lesser known credit items that oftentimes, quite frankly, folks can get themselves in a little bit of hot water and if they're not cognizant around making their payments on a monthly basis. So the 4 C's of borrowing shown on this slide, you have credit, you have capacity, you have collateral, and you have character. All of these 4 really, it really boils down to the risk. All of these play a part in your risk associated with a financial organization that's looking to make a loan to you. Your credit is your credit score. We'll talk about that in much more detail here. But your capacity, quite frankly, if we're going to lend you money as a financial organization, what's your ability to repay it? Okay, oftentimes, the underwriters here at our credit union, CQ, our job ends up being to protect borrowers from themselves, meaning that a lot of times you may have gotten a bonus or you may have gotten a promotion at your job, and quite frankly, you may not have sat down and really number crunch all of the facts and figures that may have come along with that payment increase, and as a result you want to take out a loan to go on vacation or do home improvement, whatever the case may be. Well, the underwriters really spend a lot of time looking at the capacity factor of your risk profile to make sure that you're not going to get any hot water or the company, quite frankly. The collateral, again, it's what are we using as a security measure to ensure that the debt is repaid, okay? Different types of collateral will be the home on a mortgage loan. It'll be the auto itself, the actual metal, the car on an auto loan. So it could be your signature. It could be stocks. It could be your 401k account. It could be household goods. There's some companies that will make loans against your personal collateral that's in your apartment or in your home. Those are lesser accepted types of collateral, but they're collateral nonetheless. And as you go up the collateral spectrum with order of importance and value, you often find that because you're willing to give the lien or put that piece of property up as collateral, you're rewarded in the form of lower interest rates. So for instance, if I'm going to make a mortgage loan to you, you might be able to get that loan at 3% today as opposed to a signature loan where maybe your interest rate is going to be at 11%, or say you need to take some cash out of your home to do finish off your basement or put a deck on your home or whatever the case may be, home improvement. So maybe it's not the mortgage itself, but you want to take equity out of the home, or you have the option to use one of your credit cards. Oftentimes people will elect to take advantage of a home equity line of credit because it's at a lower interest rate because that loan is secured against the property itself, okay? So that's a little bit about the collateral. We'll talk more here in a second. On the character piece, now this is where it gets a little bit gray. I always say our underwriters here within CQ and quite frankly other financial institutions and banks as well, underwriting is more of an art than a science, right? The science piece would be what your credit score is, what your debt to income ratio, etc. However, the character gets a little bit more into the art of credit and risk lending, meaning time of residence. Are you a person that jumps around from place to place? If you think about your personal situation and you've applied for any credit, they may have asked, how long have you been at that place of residence? That's not an accident, and typically they want to know where your previous residence was if it's been less than 2 years. Again, it's all about trying to find the stability in the loan that they're going to be making, the risk investment that they're going to be taking on behalf of their organization. Other pieces that go into character would be time at your job. Are you a person that has a history of jumping from job to job to job? There may be very valid reasons why you move from job to job. It could be promotion opportunity. It could be for life events that cause you to have to relocate. But at the end of the day, these are some of the questions that you may get back from an underwriter or a loan representative that you're working with as you're looking to enhance your credit. They're going to want to know a little bit more about you and why you're moving around. The other thing that goes into character, another important factor to keep in mind would be, are you renting your home or are you buying your home? Are you renting an apartment? Are you living with your parents? All of that plays a part in the character piece of this 4 C's section, and it's a very important piece because, again, it shows the stability piece. It's all about risk. When you're lending money out, you want to make sure that you're taking a smart and prudent credit risk on behalf of your organization as well as the person looking to borrow, okay? And I can assure you, for the most part, a lot of folks really get confused with the piece that it always feels like they're being told no, they're being denied for credit, or maybe you applied for $10,000 to get I don't know, to get a signature loan, but they came back and they counter offered you. They offered you an amount less than 10,000, say it was 5,000, but you didn't understand why. Rest assured that the overwhelming majority of financial institutions that are out there, the underwriting team is trained to find ways to help hopefully get you into the loan or help you out with the need that you have, as opposed to looking for reasons to deny it, right? They're always looking for ways to try and help you out, but they will ask a lot of questions. It's not that they're trying to intrude, it's really that they want to make sure that you're getting, quite frankly, in the best financial situation for both you and their company. So, moving on to the credit report itself. So we're going to drill down a little bit into some of the other factors here that I just spoke about. The credit report itself, quite simply put, it's a record of your credit history. It's a record of an individual's credit history. There are three major credit bureaus that are out there in the U.S., Equifax, Experian, and TransUnion. We'll talk more about them a little later in the presentation. Some items to keep in mind with regards to your credit report. It's often can be a confusing subject, and often can be an intimidating subject when people want to talk about the credit report itself. It's got this little mysterious aura around it, and a lot of folks don't understand it. It's really, quite simply put, it's simply a report card of the way that you're performing on those debts that you've promised to repay. Items that will show up on your credit report, or the credit report makeup, would be your trade line. These are industry-specific type terminology, but it's an individual line of credit. It's called a trade line in your credit report. So again, going back to the earlier example, I have a mortgage, I have a car note, I have a Kohl's department store credit card, and I have a Gap credit card. Well, those are 4 different trade lines that will show up on my credit report, and each of them have very different makeups when we get into looking at the scoring methodology that's taken into account for each of those lines of credit. Frankly, we would suggest that you order your credit report and review it for accuracy at least annually, and we'll talk a lot more about that later in the presentation here. There are a number of ways that you can access your credit report and information that's contained within your credit report. Quite frankly, not all of them are free options, so we'll talk about one in particular that we highly recommend within the credit union here. It is free, and it allows you one free copy of each of the 3 major credit reports every year. So we'll talk a little bit more about that. As far as the credit score is concerned, it's a number. It's a 3-digit number that indicates your credit risk. Okay, simply put, the lower the score, the higher the risk, and vice versa. The higher the score, the lower the risk. And again, that risk word is probably be the most used word I have on the presentation today, because at the end of the day, that's what we're measuring. And as a result of the risk involved with a transaction, that will determine the interest rate that you're going to pay on the transaction itself. It will determine the amount of time they allow you to repay the debt. If you're looking at a mortgage or an auto loan, for instance, if you're looking at a car loan, if you have really good credit, you might be able to extend your payments out to 6 or 7 years, depending on what you need to fit your budget. But if you're a higher credit risk, they may insist that your maximum term might be a 3 or a 4-year term. Okay, so again, there are a number of different reasons why risk will determine the amount of time and payment amount that you'll be afforded on a credit transaction. And again, FICO is the most common scoring model that's in use today. But what a lot of folks don't understand is that there are many types of FICO models that are floating around. In fact, Equifax and Experian each use up to 16 different FICO models. Remember, it's simply a model. And TransUnion uses 21 different FICO models. And what happens is, CQ is a credit union. Let's use us for an example. We can elect to go out and buy these models from any of those 3 vendors, right? Equifax, TransUnion, or Experian. And their focus items, these models, if I'm an auto lender, let's say CQ wants to get deep into our auto space, and we want to make sure that we are lending the money out on behalf of our members, as well as the people, the dealers that we're dealing with. We may choose to engage FICO for their auto enhanced model, right? It places a lot more emphasis and weighting on the method in which a person has repaid and handled their auto debts in the past, and maybe less so much on their department store credit cards or their signature loans. There are a number of different models. So again, Equifax and Experian, they have 16 models of FICO models that they can use and sell to financial organizations based on their importance. And TransUnion goes up to 21 models. So little known fact of credit scoring models. So credit score itself, what is that risk range that we're talking about? And full disclosure here, this is a typical range that we operate on within CQ. Okay, it doesn't mean that every lender that's out there, every bank, every credit union, everyone may set their high or good, fair, below average, they may set all of those levers slightly different from each other depending on what their risk tolerance is as an organization. Okay, for purposes of this slide, we really have it broken down into 5 buckets. 5 buckets. On a typical FICO score, you're going to see the credit scores will range anywhere between 300 and 850. So where we've chosen, if we look at the right-hand side of the slide, we've chosen our upper tier, our best credit risk, what we typically plus credit within the credit union here. It's at 760 to 850. That's the upper crust. That you've a couple of pieces come into that, and we'll talk about how you get an 800 or 850 FICO score versus the opposite end of the spectrum on the left side of the screen there, that 300 to 559. Frankly put, everyone, you have to put just as much effort into each of these outlying ranges to reach it. You won't get a score in the 3 and 4 and 500 range without putting effort in. You got to really try to not do right on your obligations. On the flip side, you have to try and do right on the opposite side to earn that 760 FICO score. The average score in America today, as of August of this year, was 695. Okay, so if you look at this sheet here, that literally falls right within our what we are calling average. So the actual FICO scores that are floating around for the typical American is at 695 as of August of this year, and that falls dead square in the middle of our range of 660 to 724 that we call average. Okay, Maryland specific, it's a little bit lower than the national average. Marylanders, the average FICO score for all credit transactions that are monitored, 667. So 667. Again, still falls within where we call here at CQ average, but it's significantly on the lower end of that average range, 660 to 724. Marylanders are falling at a 667, okay, compared to the overall U.S. population at 695. And an interesting tidbit, a lot of folks say, well, what's the credit score have to be to buy a home? How can I buy a home, or what are we targeting to buy a home? The average score of home buyers in America is at 728. 728 is the average home FICO score, credit score is what I should say, because there are different models, not just FICO. The average credit score for a home buyer in the U.S. is 728, again, as of August of this year. So as you can see, that places you in the next tier up. Not quite the upper crust, high range, 760 plus, but that 725 to 759 range is definitely above average. And again, going back to a couple of slides ago, we talked about the 4 C's of credit, and you've got the collateral piece, but you also have the credit piece. Well, keep in mind, just like buying a home is oftentimes the most important purchase or the most significant purchase that an individual will make in their life, it's also one of the biggest credit risks that most banks or financial institutions will take on an individual as well. So as a result, it's not an accident that you typically see tighter credit standards, especially coming off the heels of the Great Recession of 2007, 2008, 2009, where a lot of people fell on hard times with the burst of the housing bubble. So lenders really tightened their belt coming off of that, and you've seen the credit scores really migrate up to the upper ends of this tier here, and that's for good reason. We want to make sure that everyone, obviously we don't have a repeat of what we experienced a few years ago, but it's no fun to have folks in homes that either they can't afford, or it's no fun owning the home. You buy a home for a reason because you want to have pride in it. That's just an example of what we have. And I'm going to speak slowly on this next piece here. If you guys have a pen and you want to write down this website, it's a handy website that I would recommend you you go out and check out. It has a little more facts and figures on some of the information I just talked about. It's www.valuepenguin, one word, VALUEPENGUIN, valuepenguin.com, and you do backslash and type in average credit score. Average credit score with the dash in between, average credit score. It'll take you to a really nice website that aggregates a little bit additional information on the credit scoring credit score levels of different states within the population, what's the age demographics that make up credit scores and credit risk. So it's just a really cool tool. So again, it's www.valuepenguin.com / average credit score. So have some fun on that site. I would recommend. It's one that I recommend to my personal family and friends when they want to know a little bit more. Okay, the next slide here are the 5 factors that make up a FICO score itself. And again, after the slide presentation, the webinar here, you'll be provided with a handout flyer that Tim will provide that kind of aggregates all of this information. It's a really handy tool. But what you're looking at here in front of you is a typical, what I call a solid base breakdown of 100% of what a credit score factors into it. Okay, so 35% would be the way that you're paying your bills, the payment history. 30% are the amounts owed, and we're going to come back to that 30% here in a few minutes. 15% will be the length of the credit history, otherwise known as credit depth. Did you open up your credit, all of your credit open within a 1 month period, and that's all you have to show, or was it open sporadically over the last 10 years of credit building? Okay, so that's the length of the credit. 10% is the new credit. How fast and furious are you out there looking to borrow money and do new financial transactions that involve your credit? And then 10% will be the types of credit used. If you remember back a few minutes ago, we talked about installment versus revolving, but then specifically within the revolving, I mentioned those department store credit cards. Those are ones you need to be really, really sensitive about making the decision whether or not you're going to open those up or not. I know it's attractive. Black Friday's coming up the day after Thanksgiving. Big holiday sales are going to start, and as you're checking out, they'll say, well, would you like to sign up for our line of credit for an additional 10 or 15% off your purchase today? And it sounds great at the time, and you may or may not have your plan in place as to how you're going to pay for that account or that bill right back, but what they're not telling you is that you're signing onto a contract that will typically on the low end, and I mean the low end, will be 18 to 19% on the low end, and it can be as high as 28, 26, 27% on the high end for that line of credit that you're opening up. I like to call those lines of credit personally junk debt, J-U-N-K. Those would be junk debt. In other words, if you walk into a store and they have MasterCard or Visa or any other typical large Discover card, if they have one of those labels displayed on their window at the front of the place that you're walking into, but yet they offer you another line of credit at the checkout counter, be mindful that it's a good idea if you can save some money, but you have got to be really tight on the way and manner in which you're going to make sure that you can repay that so that you don't accrue very high interest rates. If a MasterCard or Visa will do and they're offering their private label, you need to ask yourself long and hard, does it make sense to open up another line of credit? Because again, it's specifically called out in most credit models that we're looking at here on this sheet. What are the types? It counts. It does weigh against you a little bit. So you just want to be cognizant about it. If you can be responsible, make sure you pay it off. It'll hit you in the wallet if you don't, but if you think you have the discipline, go for it, by all means. Okay. The other thing to keep in mind on this slide, I started talking about how this represents a solid base of modeling and breakdown of 100% of a credit score here, but other lenders, just as I mentioned, other lenders may choose to engage with different types of scoring models. That auto enhanced model for auto loans. You could have a mortgage model. You could have an unsecured model. There are a number of different ones out. Well, you can also have these same levers within those models are tinkered differently. So for instance, maybe my risk profile as an organization here at the credit union is one that I want to look and say, okay, I want people that really, if I'm giving you a $10,000 line of credit, a $10,000 credit card, I want your balance to be around $3,000 or $4,000, not $8,000 or $9,000. So to make sure that I'm getting those types of borrowers onto my customer role, so to speak, or my membership role, I may choose that lever, that upper right-hand quadrant of amounts owed at 30%. Maybe I choose to calibrate that up so that's 50% of your credit score with me, okay, and that determines the risk. So I can weigh the amounts owed at a higher risk level than, say, types of new credit or the types of credit or the types of new credit. Maybe that's less of importance to me. I want people that are responsible credit users. So financial institutions can pick and choose to calibrate these levers and these percentages to fit their risk tolerance as an organization. Okay. Moving on to the next slide here, how to build your credit score. This is a very common question that we get within the credit union here at CQ. But really, when you think about it, there's no magic sauce, there's no pixie dust to this. Pay your bills on time. If you do fall slow on somebody, repay them. Make arrangements. If you had a life experience, you felt ill and you couldn't work, or you had a problem in your family and it affected your ability to have an income and to make good on your promises for your credit ratings, make arrangements to repay any old debts that may be out there, especially your student loan debts. We'll talk a little bit more about that here in a minute. Keep your balances low. I alluded to this on the previous slide. Your utilization is a point that it sounds like a big fancy word, but the way you would factor in credit utilization, let's use that same $10,000 line of credit example I spoke about a minute ago. If I've got a $10,000 credit card and typically I carry a balance, I revolve a balance at $3,000, my usage on that credit card is 30%. Whereas person B or my wife may have a credit card that she has $10,000 on and she's only carrying a balance of $1,500 a month. So her utilization is 15%. So I've got one at 30%, I've got one at 15%. Who poses lower risk factor to a financial institution. Typically, it would be my wife. On the flip side, you hear a number of different levels that are out there. Some places say never carry your balances over 40% of your outstanding available credit lines. Some places have a tolerance up to 50%. But as a rule of thumb, I think 40% or lower is really where you want to strive to be on any lines of credit that you have. That goes for all types, whether it's those department store credit cards or your typical home equity lines of credit or any revolving line of credit. You really want to shoot for 40% or less as kind of your upper end of where you want to revolve a balance at. You may use it higher than that, but you don't want to carry a balance consistently over that because, again, it's a measure of credit risk. Are you relying on the credit afforded to you to make ends meet? Are you robbing Peter to pay Paul? Are you an example of a person who takes a cash advance from one card and pays it on another, which I never recommend, obviously, but you see some of those situations that come up where people get into a jam where they're moving money around between their lines of credit to try and play that game. Guys, it will always catch up with you, and very rarely does that situation end well. So just want to keep your balance as low as you can. Use them sparingly, and certainly the last bullet point here, apply for new credit sparingly. Really what we're talking about here is another factor on your credit score, which is your credit inquiries. How many times are you inquiring about new credit? There are two types of inquiries that are typically on a credit report. They're hard inquiries and then they're soft inquiries. A soft inquiry would be something that you've generated yourself or a place where you've already got a credit agreement or a credit relationship with. They have the right, you probably didn't read the fine print on the application you signed, but they have the right to go back in and take periodic looks at how you're handling your credit, okay? Those are all called soft inquiries. The typical person that's going out and applying for a new home or a new car, they are putting a hard inquiry on your credit report. So a hard inquiry would be as a result of your action. You're asking for new credit. So that's a signal to from creditor to creditor that, hey, Johnny or Susie are out applying for a new auto loan or a new home loan. We will see the name of the organization that you applied for, and typically it's not hard to deduce what you're actually looking to buy. If I see Ford Motor Credit and I see American Honda Finance, I see Subaru Credit and I see GMAC there, those are all types of auto lenders. Well, clearly you're looking for a new car. So those are types of things that all weigh into the factor of your risk, because the inquiry is very important, because it can typically take 45 to 60 days for a new line of credit to actually show in your credit report itself. So if we see some inquiries in there from an underwriting standpoint, we're going to roll up the sleeves and say, okay, Johnny, I saw an inquiry from Honda. What were you looking for, right? Clearly you were looking for a car. Did you buy a car? If so, what's the new payment? What's the new amount of that? All of those factors that we're going to need to take into consideration when making the decision on your new request for credit, we need to understand truly what does the picture look like, and inquiries are another way to do that. So by applying for new credit sparingly, whether or not you actually go through and get the credit afforded to you or that you were looking to apply for. You may have applied at 15 different places for a mortgage loan or for an auto loan. If you never consummated a loan somewhere else, that's one thing. But the inquiry themselves can have a small impact on your credit report itself, on your credit score itself. Too much less of an effect. We'll talk a little bit more here in a minute, but much less effect from a weighting standpoint does the inquiry count against you as opposed to not paying on time. So if you look at these 4 bullet points on the screen again, paying on time and going back to here, I'll go back one screen, the payment history and the amounts owed, those factors, again, in most base models, those are far more important to a lender from a risk standpoint than how much new credit are you taking out or what's the length, okay? If you're a good credit good user of credit and a good credit risk, it will show and you'll be rewarded in your credit score itself. And we often, while we're on the screen, another question we typically get here at the credit union from our membership base is, how long can negative items stay on your credit report? Number one, you never want to hear that question. That means typically something has gone wrong that we need to have another conversation about. But typically it's about 7 years for anything that's delinquent. Any delinquent or derogatory items will stay on your credit report for up to 7 years. Bankruptcies will stay on there typically for up to 10 years. There are exceptions to both of those numbers, okay? They can be longer or shorter, but for the most part it's 7 years for just general delinquencies or any other negative impact items on your credit report. And that's 7 years from the date of last activity. So not from the date you open up the card and you say, okay, well, I opened it up 5.5 years ago. I went slow a year ago. Well, no, it's 7 years from the time that you had the last activity. So if your last activity was the slowness a year ago, you've got another 6 years to wait before that is going to be not weighed against you on your credit report itself. A couple of other important items to keep in mind. If you fall slow with someone, and I cannot stress this enough, if you've fallen slow for whatever the reason, whether it was something you should have done better or something that happened to you, right? You had a car accident, you couldn't go to work, you couldn't afford to pay your bills, whatever the reason, you've got to pick up the phone and let them know what's going on. A lot of folks get into this false pretense that, hey, if I put my hands over my ears and eyes, it's not happening, no one's going to see me here. You won't be able to wait it out. You cannot wait out the bad marks. You're not going to be able to wait the 7 years. You're going to have credit needs, okay? Eventually, they're going to grow tired, and they being the financial company, they're going to grow tired of trying to connect with you and contact you to see what's going on. Then you're going to get the advanced collection calls, and before you know it, you're going to have a charge-off where someone has just given up on collecting a debt that you re-owed. You had a contract agreement in place. You defaulted on that. It's gone all the way to the point where they've thrown their hands up. It's probably the most serious negative mark on an individual credit file that you're going to see would be a charge-off debt. So by all means, it's one thing to be slow, which is never advisable, but it's another thing to be slow and never acknowledge the fact that you are slow and try and make payment arrangements. So when we talk about building your credit score and keeping a good credit score, the moment you feel that something's going to happen to impact your ability to repay your obligations, please pick up the phone, let the folks know. If you got to make 5 different phone calls, you need to make all 5. Don't rely on other people to do it for you. They're going to want to talk to you, get more information on your situation. That's one of the most important pieces of information I can leave you with today. I highly encourage you to even if you're dealing with something today, pick up the phone after this webinar and call them, talk to them. Many times they'll have repayment options, they have workout plans for you, etc. Because just like you don't like being behind on your bills, they don't like taking losses on loans that they've made either. So they're going to try and find a happy medium, and they will generally work with you as a financial institution. And maybe it's deferring monthly payments. Maybe it's taking your delinquent payments and putting it onto the back end of your contractual agreement. There are a number of different ways that you can help someone out that's fallen on some hard times, as opposed to just letting the credit score continue to suffer. So by all means, please pick up the phone and call. Another important piece to keep in mind, there are 2 types of debts that are not forgiven through any bankruptcy, no charge-offs. You're not going to be able to avoid this. They would be tax liens and, ironically, your student loan debt. Student loan debt is not forgivable in a bankruptcy proceeding, at least not for student loan debt that's federally insured. If it's a private student loan, that's a little different. But if you've got your typical Sallie Mae loans that are out there that you've used to finance school and you fall on hard times, and you think that bankruptcy is the way to go to relieve yourself of those debts, you're in for a rude awakening, because those will not be forgiven. They will still be waiting for you at the end of that bankruptcy process. So again, pick up the phone and take the medicine and oftentimes have the unpleasant conversation, but it's better to deal with it head on as opposed to kicking the can down the road, because it will not go away. Let's see here. As far as your credit report, I alluded to this a little earlier. What I would recommend everyone do is write down this website that you're looking at, www.annualcreditreport.com. It is truly a free website that you can get your credit reports from. What you will not get for free by accessing this site are the credit scores. Remember, the scores are analytical models, right? So Equifax and FICO and TransUnion and Experian, all these places, they're paying a lot of people a lot of money to develop these models and tweak these models. So while the report card itself, the credit report is your report card and a history of how you've performed, that's okay. It didn't cost them anything to gather that information, maybe some small amounts, but nowhere near the amount that it costs to develop those models. So you will not be able to find a credit score out there without some sort of, whether it's a subscription service where you pay a small monthly fee and you get access to your credit scores on an on-demand basis, or you pay one time up front. Typically it's between $8 and $15 depending on the vendor that's selling you a copy of your credit score. But it's important to keep in mind, some people will invest in these credit scores through these third-party places and not realize that if you go back to that pie chart where the weightings are, well, the scores are going to vary from place to place. Very rarely will you get a credit score that's going to be the same across all different financial institutions. For instance, you may pay big money for this copy of this credit score and your credit report, and then you turn around and still be told no for an application for credit that you tried. They may have you in the 400 or 500 range, and you have a credit report showing that you're in the 600 range. But again, they are always going to go with their models, meaning that they, being the financial institutions, always going to rely on their credit scoring models that have been calibrated to their risk appetite for their organization. So I say that to use it with a grain of caution, that if you're going to choose to elect to pay for a copy of your credit report with the score that comes with it, that score may not have a whole lot of worth to the places that you're going to look to engage to get credit transactions. So just a word of caution on that. But on this website itself, what's unique about this website, they passed the law, Congress passed a law back in 2003. It's called the Fair and Accurate Credit Transactions Act, FACTA. That's a mouthful, FACTA, FACTA Act. And basically, the primary reason that this act was enabled or passed, it was to help head off identity theft, but also from an educational piece that I talked to earlier in the presentation. It was really designed to encourage Americans to be more knowledgeable about their credit reports, to peel back the veil of secrecy sometimes that financial institutions and banks would operate in, and not justify the reason why one person's getting one interest rate, another person's getting another interest rate. So this was a law that was passed in 2003, to hopefully level the playing field. Well, as part of this, this website was jointly created. It's one of the few things that in the competitive world of these data analytics companies, Equifax, Experian, and TransUnion, they actually came together and formed this website. It's a jointly operated website by the three of them, and that's why it's truly a free site that they've agreed with the federal government to provide the American consumer access to. There are many other websites that are out there, your freecreditreport.com and creditkarma.com. There are a number of different websites that are out there, but this for sure, we recommend our own members go to check out this website. It is 100% free unless you elect, and you will be presented these options from the three credit agencies. You'll be offered the option to purchase your credit score. Again, if you opt to go that way, just know that it may be only of use to you and your edification. Okay. Let's see here. And the other thing I would also recommend too, we've also had some reports from our membership base where if you're not careful in your typing of this website, this domain in to your website itself, you go to annual credit reports, you put an S behind credit and between the T and the R, between credit and report, you put an S there, or you change .com to .gov or .org, you're going to be taken to a number of imposter sites, okay? And quite frankly, I would be very careful about entering any of your social security information or anything like that from an identity theft prevention standpoint. So just be careful, double check. It's annualcreditreport.com if you're going to elect to go to the site. And the unique thing about this site too, while each of the credit reporting agencies are required to offer one free credit report every 12 calendar months, you don't have to take them all at one time. So for instance, you may go in January and say, I want to get a copy of my Equifax report and check out the data, make sure everything looks accurate, etc. Well, now I'm going to wait 4 months, and then in May, I'm going to go in and get my Experian report for free from the same website. And then maybe you want to wait until September or October there, 4 months later, and get a copy of your TransUnion. So by doing it that way, you'll typically find that the information, remember, these are basically report cards. This is just reporting out how you've handled your debts. So very rarely will you see that information varies greatly from Experian to TransUnion or Equifax, but what you may find out is that not every financial institution is required to report to all three entities. So depending on geographical areas, there are certain banks and credit unions that don't report to all three. They're only required to report your information out to one. But again, it's just important to understand. So you may see that I have a car note, or I have a regional bank loan that's only reporting with one credit union, and one credit reporting agency, but not with the other two. That's not necessarily a bad thing. It could be by design. That financial institution has just elected not to report to all three, but they're meeting their requirements to report to one of them. So just keep that in mind. If you want to get them all three at the exact same time, that works as well, but I would recommend, just another little tip, space them out, okay? That way you can access them all for free throughout the life of, throughout the year, and not have to pay an additional fee to get it, okay? With that having been said, I apologize if I was talking a little fast here. I wanted to leave ample time for questions. So Tim, we've reached the Q&A section, so I'm not sure if any questions have come in, but I'm all ears.
Yes, we do have a few questions. So the first one is, I've heard that no debt is bad for your credit score. Is that true?
That is not true. No debt, it depends, because now let me back up. No debt is not not necessarily bad. What happens is the type of debt that you're having, right? So if you have no debt and you paid that debt, or let me back up. If you've had a line of credit, you defaulted on the line of credit, it's paid off. Now that payoff shows as a zero balance, but the last reported activity was a negative mark. that goes back to the 7-year piece. So if you have no additional debt or no additional credit outstanding to offset, meaning the behaviors, you're buying time and you're showing good behaviors, yes, it could hurt you to not have any additional debt if the debt that you're showing on your credit report was negative. If it's positive, by no means. But that said, one thing you want to be careful about is lowering down and closing out lines of credit. A lot of people will say, hey, I was approved for a $10,000 line of credit. I don't need that. I'll never run that up, but I have another 3 other lines of credit that are out there. The credit scores are set to aggregate available credit across all of your revolving lines of credit. So if I've got $10,000 over 10 credit cards and I close down and shut down 3 of those lines of credit for $1,000 each, well, now I have $7,000 in available credit. Well, it goes back to the utilization. If you're carrying balances of $5,000 on that $7,000, your utilization has really shot way up when all you were intending to do was lower down and close out those other lines of credit that you had no balance on. So just be careful about that. It's okay to keep lines of credit open. Just pay the balances down to 0. You will not incur any interest on that. But it's important to keep the lines of credit open if you can. It's not a bad thing at all unless it was bad when you paid it off, and that's all the credit that you have.
Okay, this question is, you mentioned that the FICO score is based on types of credit. Is it good to have different types of credit or a single type of credit? And then what are those types of credits that you're referring to?
Yes, specifically here, I'll go back over just the types of credit that we were talking about. Generally speaking, well, let me take the last part first. The types of credit are credit cards, your installment loans, i.e. your mortgages, your an installment loan is something that has a fixed payment and end term, right? So it's a 3-year note, it's a 5-year payment, it's a 7-year note. Those can be signature loans, those can be auto loans, those can be mortgages. Then you have your revolving lines of credit, your home equity lines of credit, anything that ends in credit, right? Lines of credit, it has the ability to revolve. So your credit card, your lines of credit, your department store credit cards. So those are all the types. And then the last type would be your open credit types. Those would be your charge cards, your American Express cards, cards that require you to pay off within 30 days. But more importantly, your cell phones, your cable bills, your gas and electric. Those are the types of credit. Tim, can you say the first part of the question again? I want to make sure I'm answering that now that I've addressed the types.
I think they were wondering if it's good to have a lot of different types of credit, or if it's good to have maybe only 1 or 2 different types of credit.
Yes. Here's what I would say. I would never advise anyone to just go out and open up different types of credit for the sake of opening it up. I would advise you to generally live your life the way that you need to, and as items and offers come to you, take into consideration if you need, say you're a homeowner, right? We get a member that calls us up and they own their own home. They have the ability to take a home equity line of credit, but they can also take a signature installment loan, right? If someone already has several different signature loans out there and it's not going to hurt them, it's not going to adversely impact them to open up a line of credit to diversify some of the types of credit that are out there, we may suggest that they look to go with the home equity or even the line of credit. Maybe it's a signature line of credit versus an installment loan. Again, if you look at the screen that I put back up, the types of credit that are used, in most base models, it's about 10% of the makeup. So yes, it does matter, but not nearly as much as are you paying your bills on time and how are you managing the credit that's afforded to you. So I'm hoping that's answering it, your question. It's an ambiguous answer because I would never say go out and just open up an auto loan to say you have an auto loan. If life dictates that you need to get a car loan, I think that's clearly a good type of credit to have there. It shows that you've paid a rather large purchase over a good amount of time to create credit for yourself. But I would never encourage you to just go out and open up different types of lines of credit just to say that you have them.
The next question is, does applying for different credit cards from the same bank constitute a hard or a soft inquiry?
It would constitute a hard inquiry with one exception at most financial institutions. If you're doing it all within a 30-day window, typically most banks will only put one hard inquiry on your credit file within in a 30-day period. So if we're talking to a member and they're doing a mortgage loan with us and they also want to bring their car, they want to refinance their car note with us and they want to get a credit card and they want to do it all at the exact same time, many times we will be able to use one single credit inquiry, one hard inquiry to evaluate the credit risk for all 3 of those product types that we're looking to do. Okay. Now, if you want to wait and then reapply at at your bank and now you bought the mortgage and you purposely don't want to take on too much debt too fast, again, looking at length of credit history and type and new credit, you want to wait 6 months. Well then yes, in 6 months when you go back in to apply for that credit card or that auto loan, that will absolutely show as a hard inquiry. What will show as soft inquiries is that typically for most credit card companies and most financial institutions, after I've given you the credit card, I may go in every 12 months and take a look at it and just to see, are you getting overextended, etc. Because what happens is you can either be rewarded or you can have some cautionary measures taken. So if I've got a $1,000 credit card with you, every year I go in and look and monitor how you're handling not just our debt, but how you're handling other debts around us. I may raise your limit from 1,000 up with you not even having to apply, or maybe 1,000 to 2,000 to reward the fact that you're paying us good and you're showing good credit usage on others around us. But conversely, say I've given you a $3,000 line of credit, and now I typically see that you're ranking up a lot of debt. Since you've opened up a $3,000 credit card with me, you've got 4 other places that you've racked up credit cards with. I may go in and proactively lower my limit with you from $3,000 down to $1,000. And again, that can have an adverse impact on your credit score. Say you have a $3,000 credit card with me and you're carrying a $3,000 balance. Now I go in and I lower your limit to $1,000. Well, guess what? It's totally within the rights of the credit union or the financial institution to do that, but now your revolving utilization, the percent that you owe versus the credit limit, is way out of whack now, and now that could also hit your credit score. So just be cognizant of how fast you're taking on debt and how fast you're doing it. But back to those all result from soft inquiries as opposed to hard inquiries that you're going to do on yourself.
Okay. This is my first time applying for a credit card. Is it bad to apply for 3 different cards at about the same time?
I definitely, if it's your first time applying for a credit card, I would take it slow. I would get one and look to build credit with that one organization. The caveat to that, if your credit card is of the junk variety that we talked about a little earlier, I'm not a big fan of your Old Navy's, your Gap, your Abercrombie Fitch, all those places where a normal MasterCard or Visa will work. You absolutely want to go the normal MasterCard or Visa line. I'm not going to sit here and promote any one vendor over that. It's just about the Visa and MasterCard versus the private label credit card. So my recommendation would be get one line of credit. It might be a smaller limit. It might be $500. It might be $1,000. It's not going to be enough to get you in any trouble, but it's certainly enough that you can use at all those other places of retailers, your Target, your Walmart, your Best Buy. You can use that same Visa card there and build up your credit with them. And over time, what you'll end up seeing is that they're going to increase your available limits with them. But I would not do it too fast. And by too fast, I would say maybe 1 a year if you're going to look to apply for new credit. And again, ask yourself, why am I applying for the new credit? Is it simply just to have more credit show up in my credit report, or is it truly that I need the availability? If it's about availability and increasing lines of credit, I would recommend you call back the bank that you got the credit card from to see if you're eligible for a credit limit increase based on the credit performance that you've or credit worthiness that you've built up with that organization.
And then it looks like we need some clarification. A couple of people asked, basically, did you say that the free credit report that one is entitled to does not include the FICO score?
Correct. It will not have a credit score on there. They will sell the credit scores to you. It's because, again, those are proprietary models and they're paying employees to constantly tweak those models. So they will not give that information away for free. That's research and development on their side that they're going to be compensated for. However, the actual credit report itself, that's your information, that's your performance data. That's why you get that for free. But very rarely will you find a free score out there available to you without some sort of a subscription services being offered, or you truly may be able to get free credit scores on an as-needed basis if they're hoping that it will lead to additional business. But those instances are very rare. Along those same lines, though, Tim, and for everyone listening, most creditors are now starting to enhance their online banking services or their online website services, so that if you have an existing relationship, they're contracting with FICO and Equifax and other places to show you your score for free based on the fact that you already have a relationship with them. So I know Discover Card comes to mind. You can get your credit score for free because you have a relationship with Discover Card. So those are the other options as well. So if you already have existing lines of credit or credit cards, I would recommend you start with them on their websites. A lot of times people don't realize that you have access to your credit score at least how they would score you for their organization for free, or you could just go out and opt to pay for one of the credit scores that are there in the base models.
This person is asking, or a couple of people are actually asking, does your credit score decrease every time there's a new inquiry, and by what percent?
Yeah, it's a hard question to answer with regards to what percent, but the short answer is that yes, you're typically going to see a small drop, and by small, anywhere between 1 to 5 points per inquiry, per hard inquiry, and it typically will take about, anything less than a year, they're still going to be weighed and factored in, but really the last 6 months is really what they're when the most weighting or negative impact will be felt from a bunch of inquiries. It's typically 1 to 5 points per inquiry, and you really want to be careful in the 6-month window. The most recent 6 months are going to weigh on you more than something that's in months 7 through 12, and typically all the inquiries will drop off at month 12. Some places will carry them out to 18 months, but again, there's very rarely a hard and fast percentage of what an inquiry is going to hit you, because again, it does vary at the individual financial institution level as to how important that part is to them.
For the 5 factors on the amount owed, did you say it looks like the outstanding balance or unpaid balance or the average monthly balance? Is it good to just keep... Oh,
I'm sorry, go ahead, Tim.
That's okay. Is it good to just keep paying off each monthly balance, so we should maintain some kind of unpaid balance to show we're utilizing our credit limit?
Yeah, it's a great question. We get that question a lot. Again, the definition of credit is paying, using money and paying for it over time, or paying for it later, right? So it's a double-edged sword. It's like a catch-22. You want to accrue the credit and get the credit depth, and the only way you're going to do that is by carrying some sort of a small balance on your credit cards. But when you carry a small balance, you're also paying interest on the credit card, right? So it's one of those deals where if you have the option, what I would recommend, even if it's $1 or $2, if you can keep an outstanding $1 or $2 on your credit card, because again, if it has $1 on there, they're going to report your credit history to the credit bureaus, so you get the credit for having good credit, right? Even though it's truly only like $1 or $2, maybe $5 that you're going to carry. Maybe you get a tank of gas and you want to allow that balance to roll. You are going to pay some finance charges on that, though, so keep that in mind. Otherwise, what you've really done is you've turned your credit card into one of those open charge cards. Again, think American Express versus Visa. Most American Express cards require you to pay the balance off in 30 days. So sure, it will show that you've been paying the account as it's agreed, but it doesn't really show that you're paying it over a number of months and establishing credit. So it's a tricky answer to that, because on one side it's going to cost you money when you maybe not have to, but you need to be cognizant about that and keep the amounts as low as possible to truly acquire the depth of credit that we're talking about here. Because again, looking at this here on the screen, let me cancel that out, sorry about that. It's about 15% in most base models is the length of credit history, and the only way you're going to get that credit history is to actually have some utilization on those cards.
Okay. I think you just answered this, but it's asked in a different way, so I want to ask the question. If you have a lot of credit cards that you don't use and have no balance on them, is it wise to close the cards, and will this affect your score?
I would recommend leaving the lines of credit open. I will very rarely recommend that you shut a line down, because again, if we go back over, go back a few screens here in the presentation if you're still looking at the WebEx. If you look at the 4 C's of borrowing, all of those factors, if I've got 4 different credit cards and they're each worth $5,000 and they're all zero balances, and it's more money than I'll ever need to use on a credit card, $20,000 over 4 different credit cards, that speaks to both your character piece as well as your capacity as well. So clearly you have the ability to use your credit cards sparingly, and you have the responsibility and habits to repay them back, but more importantly, it also shows that, look, you don't need to be protected from yourself. You can be trusted to have these lines of credit outstanding and not have to worry about it as a financial institution or bank, that hey, you're just because someone gives you $1 that you can borrow, you're gonna borrow that dollar. Or someone says you can borrow 1,000, you're gonna go out and borrow $1,000. So I would highly recommend you always leave the lines of credit open, because again, it shows responsibility on your part that you can truly manage the amount of trust that's been afforded to you in the form of those credit lines. So, and the other piece to keep in mind too, no matter how small any outstanding balances that you might revolve, I know this is a little unrelated to the question, but it could lead to others. If you've got that same example that I just used, $4,000 or $5,000 lines of credit. So you've got $20,000 in total available credit. But on one credit card, you elect to carry a $4,000 balance on $5,000 on that one card. So it's truly $4,000 divided by $20,000 of available utilization. Well, if you go in and you start shutting down the other 4 credit cards that you don't need for $5,000 each, you've now turned that 4,000 over 20,000 into 4,000 over 5,000 available on that one single line of credit. You've blown that utilization up to 80% of that line of credit. That will absolutely have an impact on your credit score. So you were just trying to do the right thing about shutting down lines that you don't need, but you ultimately end up inadvertently hurting yourself from a risk standpoint by doing that. So just really, again, I tend to talk in some ambiguous terms because all of the situations are going to be different in some way, shape, or form. These are typically the most applicable responses to the general population.
I have a home equity line for investing purposes. Does having that active negatively affect my credit score?
No, it should not, depending on how much of utilization are you using on the card, on the line of credit itself. Again, a home equity line of credit reflects on your credit report as like any other revolving line of credit. It's like a big credit card. So the same rules would apply. I would always recommend to keep the balance versus available credit to 40% or under if at all possible. And if you're going to run it up, you want to make sure that you make consistent payments to gradually pay it back down. But no, there's it should not, as long as you're repaying the debt on time and you're using it responsibly, not doing things that will get them to any default fees or late payment fees where these fees get added to your balance and now those balances can put you over the limit, those types of things. Anything that would happen on a normal credit card can also be applied to a typical home equity line of credit. So you just want to treat them the exact same way. It's just a bigger amount that you're generally talking on home equity lines of credit.
Great. It looks like we have time for one more question, and it is, how does FICO compare to the actual credit score, that's in parentheses, lenders see when they run a credit check on me?
Well, it varies. It goes back to what I spoke about earlier. FICO is a data analytics company, right? They have up to 21 different models that financial institutions can look to sell to companies. So it really does depend on what's important to the company that's buying what model from FICO. So there are a number of different models. It's too many variables to truly give a concrete answer to that question, other than the fact that it should never be totally out in left field, meaning you should never have a credit score. If I go back over quickly to this chart here, you should never have a score on one report that a lender's showing and reporting you that you're in the 560 to 659, but you're buying a credit score from a third party. You've chosen to go out and purchase it, and your report shows that you're at 820. You should never have a variance like that. The variances in general will be from maybe 660 on your report to 670 that the company is showing, or 700 on your report to 690 that the company is showing. They should be within reason, but there should never be very large variances between the credit scores that you're seeing.
Great. That's all the time we have for now. Thank you, Toby, for this presentation. There are a lot of nuggets of information in there that I hope people are able to use. And for those of you that listened in, thank you for your time. We hope that you had a good time and learned something. I will be sending out a recording of this presentation along with the handout that Toby referenced earlier in the presentation for you to use. And we appreciate your time, and go Terps. Thanks, everyone.
Thanks so much, Tim. Bye.